Nvidia is trading for $145 per share, and I am going to be acquiring Nvidia for cheaper than this current price in the market by using put options. In this video, I'm going to show you how I'm going to use put options, what strike I'm going to sell a put option to acquire Nvidia shares, and how I'm going to manage and close this put option for profit. I'm also going to talk about the price that you should be buying Nvidia right now, because if you're buying it at these levels, you should be careful despite Nvidia having a really bright future. So let's make a quick recap about why Nvidia stock and why I believe this is such a good investment for the long term. First of all, AI and semiconductor market is incredibly strong, and that is going to continue for the rest of 2025 going into 2026. There's actually explosive momentum in AI and the sovereign AI push. So Nvidia is at the forefront of the AI boom, particularly with its groundbreaking Blackwell architecture, powering both data center and new GeForce RTX 50 series. CEO Jensen Huang's sovereign AI vision helps nations build secure, independent AI infrastructures, opens a massive 1.5 trillion total addressable market. Guys, total addressable market is a really important factor that I address when I'm looking at investing in a company, because the total addressable market is the opportunity that the company is going after. And the market is incredibly large for Nvidia. Even if they have some issues in China and there's some restrictions, they will get around that. It's only a matter of time. Looking at Europe alone, it represents $120 billion as part of that total addressable market. Now, fiscal year 2025 Q4 revenue hit a record $39.3 billion, with data center revenue surging 16%. Okay, that is the most important thing, and the reason why I bought Nvidia before it had earnings was because I thought that data centers would do very, very well. The past month, Nvidia is up 8.16%, which is basically just shy of 10% in the last month. The last 3 months were up almost 25%. So the recovery has been very real for Nvidia, and I can see this momentum continuing to go up to $180 per share, $200 per share in the next 12 to 18 months. Now look, instead of buying Nvidia right now for $145 per share, I have a much better idea. You see the current price, $145? If you were to buy 100 shares, that would cost you $14,500. Now, what you should do instead is you want to acquire Nvidia for cheaper. So the way I'm going to do that is by going to trade options on Robinhood or any brokerage platform that you're using. If you're in Canada, that's okay. If you're in Australia, that's okay. You can use a different brokerage. Now, what I'm going to do is I'm going to sell a put option. And the reason why I want to do this is because selling a put option generates income, and it's very similar to buying shares of stock, except I am able to buy it for a cheaper price than the current market price. So Nvidia is at 145, and let's say that I want a discount. I don't want to buy it for 145. Instead, I want to buy it for 140. Well, what I can do is I can go for a 140 strike, okay? Now, I'm going to go for an expiration date that's going to be about 30 days out. So I'm going to do a 30-day option, and I'm going to sell a put option. Now, me personally, it's hard to determine the value of Nvidia in the short term. You really don't know. Week to week, nobody can predict the market. And if anyone says that they can, they're completely just trying to sell you the dream or whatever, right? The truth is, we don't know the short-term value of Nvidia, but the long-term value of Nvidia is pretty clear. It's going to grow. In the short term, it is going to bounce up and down by $5, maybe $10, and that's normal volatility. It's going to go up and down, and there's no point of trying to predict the next 1 to 2 weeks or something like that. However, in the next 1 to 3 months, we are likely going to see Nvidia continue momentum and push to $150 per share. This strategy right here, selling put options, is a very conservative strategy, because right now, if the momentum slightly cools off, Nvidia pulls back just a little bit, you will end up being assigned if you're using this strategy. See, when you sell a put option, let's say at 140, and Nvidia pulls down to 140 at expiration, then you will be getting assigned shares at 140. And that's a good thing, because instead of buying it for 145, you get a $5 discount, which is essentially $500. So you can put $500 in your pocket by selling a put option at 140 strike versus buying Nvidia at 145. And not only that, not only do you get a $5 discount, but you also get paid $335 for even opening this position to begin with. Now, there's 2 things that can happen. Nvidia can slightly go up, right? It can go to 150, and you would just make $335, which is like the premium that you collect here. If Nvidia goes sideways, then basically a stockholder would make no return, right? But you would still get the 335. So you're still going to make $335 regardless. If Nvidia goes up, if it goes sideways. Now the third scenario that can happen is if Nvidia goes down, say to like 135, right? You will be getting assigned Nvidia at 135. You will have to purchase shares at 140, and you're still going to hold Nvidia at the share price of 135, right? So that means you're going to lose basically $5. However, let me point out that a stockholder would lose $10. Okay, they're losing 10 from the current price of 145 down to 135. They lose 10. You personally lose 5, right? But it's a little bit better than that because you still get the 335 premium. So in all reality, not only are you down less than the stockholder, you're actually not really down $5 because you collected 335. So you're actually only going to be down $165 because you're down 500 and then you have 335 that you have collected. So the difference there is going to be 165. Another strategy that you can do just as a bonus strategy is you can actually sell a put credit spread to profit off of Nvidia going sideways or up. So for example, we can go a little bit lower because the lower that you go, the safer it is, right? So if you look at the 140 sell put here, it actually has a 32 delta, which means that there's like basically 3 out of 10 chance that you will get assigned, right? Like 3 out of 10 times you will get assigned, which is actually pretty low. It's actually a pretty low chance of getting assigned. So let me just explain the risk, right? The chances of getting assigned here. So if you were to go for like 145, your delta is going to be higher here at 0.45. So the chance of getting assigned is like higher here. And the lower that you go, the lower the assignment risk is. So like 135 is going to be 22 delta. And as you go lower, then the chances of getting assigned are lower. However, you kind of want to get assigned here because the whole point of the strategy is stock replacement. So you're trying to have a similar position to owning stock. You just want less risk. You want more cushion. You want more margin of safety. So this is going to be a great strategy for that. By the way, here's an amazing chart that I recently made about selling put options and the risk of getting assigned. I want you to watch this quick clip and then we're going to continue on and talk about put credit spreads. Here's exactly how to tell if you're at risk of being assigned when selling a put option. So let me illustrate how this works with the chart. Let's say that you're selling a put option 100 days until expiration. The bottom of the chart will represent days and the left-hand side of the chart will represent delta, which is essentially a scale of how likely you are to get assigned on a scale of 0 to 100. And we're showing right now a line of assignment risk. You see how the assignment risk goes way up as the days are approaching 0. Your safe zone is right here. This green area is from 100 days and beyond, you're very, very safe. Now you see here is your moderate zone. The moderate zone really starts to happen in the final month, especially in the final 2 weeks. See, if delta is high, there's still a lot of time left, it doesn't really matter. Your assignment risk is still very low. However, if delta is 50 or higher, in that range, it starts to become moderate, especially in the last 2 weeks. Now you see here the risk zone. The risk zone where delta is say 60 to 100, that's where your risk starts to really go up. So for example, if you have an 80 delta option and you have sold a put and it's 80 delta and there's only 3 days left, you are definitely in the risk zone and your chances of getting assigned might be 50% or more. So here's how a put credit spread works. You're going to want to go down a bit lower to give yourself more margin of safety and lower delta, so the risk of getting assigned is lower and the risk of this put credit spread going to the money is much lower as well. So you just sell like a 130 put option, and the only difference with the put credit spread is you're just buying a leg lower. So you're going for 130, now you're going to buy the 125, and now this is a put credit spread, right? I have videos on put credit spreads if you want. Just like type in invest with Henry put credit spreads or spreads. I have that in my playlist. I have like a whole course, actually a free course on like spreads and the ultimate guide to trading spreads, and I cover this often, so if you're new, then also in the 6-hour course, by the way. So there's timestamps so you can go through the strategy. But real quick, essentially you can sell a 130 put option, then you can buy a 125 put option here. And this right here is pretty advantageous because you're gonna make 50 bucks and you're only gonna risk 450. So, the profit here is like over 11% in 28 days. So that's obviously a huge, massive return. And this is a strategy that I would personally open up for sure, just in small quantities, like 2 to 3% of your portfolio. So I actually plan to open this up today. Today's expiration day, June 20th. I'm actually going to open up more spreads when I have my Discord call on Monday as I free up capital. Because the third Friday of every month is traditional expiration. And that's typically the expiration that I trade options for, right? So to be honest, yeah, like the reason I picked July 18 is because it's the traditional expiration as well. So the next expiration I would pick would be like August 15 September 19. You can actually see here how it's always, as you go further out, it's only really the third Friday expirations. That's because it's the traditional expiration. You know, I worked on Wall Street, but I don't really remember why it's a traditional expiration. It just is, but if you want, you can go ahead and Google it. So anyways, I hope that you enjoyed this video. Nvidia sell puts is really smart. Nvidia put credit spreads is also really smart because I think Nvidia has tremendous support and we have good momentum, but in the short term, we may get some volatility. And if it pulls back, then selling put options is pretty genius. And put credit spreads that are way out of the money is also like amazing strategy as well. So go ahead and watch more of my spread videos if you want to like kind of solidify that knowledge. I have like free courses on this YouTube channel. So I'm providing free content that's better than everyone else's paid content. So there's no other reason to like pay for anyone else's content. I have everything for free, which I spent months on just to make you more profitable. And that's what I love to do. So subscribe and I'll catch you in the next one.